Quick question for you guys. I'm looking at a property that has 5 units. Its monthly income is $2,475. Asking price is $150K. I like that it's well above the 1% rule. I'm still waiting to get the rent roll, monthly expenses report to verify the income and operating costs. Tenants pay all utilities. I'm estimating monthly expenses to be around $600-700 a month. Hopefully that's high. So if I can't get the property for less than $150K, I'll be putting down $30K, estimating loan at $120K with a 6% interest rate. I'm estimating it high because I'm not sure what rate I'll get yet. I should be finding out tomorrow. Property management is 8% per door, which comes to $198 a month. NOI is $1,677 with an estimated loan payment of $720 a month. After all these numbers, estimated cash flow is just under $1,000, which is just over a 13% cap rate and a 38% cash-on-cash return. The numbers look good so far. I just need help trying to figure out how to calculate vacancies. So I'm going to touch on 2 things. One, I'm going to touch on vacancies. And then very quickly, I'm going to touch on this deal itself. So almost $2,500. So it's almost $500 a unit in rent. Now, they do pay utilities themselves, which will bring your expenses down. But $600 a unit a month, that's a very, very low ratio. If you add in property management, now you're at, call it 200. Now you're at 800 to 900. That's closer, but that's still very low. To me, it sounds like it's very low, and there's probably something they don't know about the property. If you're at 800, 900, and it's bringing in $2,500, you're at roughly 35%. A property that has tenant paid utilities with a rent in the 500 range is probably going to be closer to 40, 45, 50%, depending upon location, because taxes and insurance are a big part of that. Your variable costs are going to change. It just seems very low to me, not knowing where this property is, what condition it's in, what age it is, etc. So just from a high level, I'd be very wary of that. As well as, I think, where is it? $720 a month. Whatever, that's fine. But the question was asking about vacancies and how do I find vacancies? How do I account for vacancies, etc.? So one of the quick ways to look at it is if you had every unit vacant for 1 month, it's about 8.25%. So you take 1 divided by 12, it's about 8.25. That's a very quick way to do it, but it may not be right. So you could account for 91, 92%. But a lot of stuff on vacancy has to do with the market as well as what your plan is. Because the market could be 100%, and this property could have been 100% for the last 20 years. But if I want to renovate every unit in the first year, I'm going to probably have to have people move out in order for me to renovate units. So my occupancy is going to drop, regardless of what the market, regardless of what the property has done. So you have to know exactly what you're looking to do and how long, vacancies for renovations or permits or things like that are going to take, and factor that in. However, one thing I would look for is, one, find the historical numbers and see what it's done for the last 5 years. If they've owned it for longer, ask for longer. That's going to be a really good indicator. However, one of the properties we're buying has been 98 to 100% occupied for the last 3 years, but they're about 15 to 20% below market on rents. So it's not a true representation because all the other properties are much higher, so people obviously want to stay there and live there, so their vacancy is significantly lower, which is a plan and a structure a lot of people look for. But for us, we know we're going to be renovating units, and the market is around 95, 96%. We know that's probably going to drop below that because we're renovating units a little bit, so probably 93, 94%. So for the larger stuff in the commercial properties, it's easier to find market data because there's big companies that do it. There's companies like Yardi, Reis, R-E-I-S, what else? CoStar, Reonomy. What are some other ones? I'm forgetting some other ones, but they all gather this information on a weekly, monthly basis, and they find out what vacancies are. Another way to do it is don't buy a property for the first 6 to 12 months and just continue to look at properties And soon you'll start to figure out, okay, here's what the vacancies are in this area as I've looked at more and more properties, and you can start to get comfortable about, what it's been. And as you talk to brokers and other owners in the area, you can start to find out how this area is done the last year, 2 years, 5 years, 10 years, etc. And just figure it out that way. Another way to look at it is continue to look at listings and see how long listings stay on the market. And a little bit more work. You have to check in every day or every couple of days or every week. But you can see, okay, this listing at $700 stayed on the market for 5 days. This listing at $1,200 has been on the market for 150 days. So you can start to balance out, okay, vacancies at what price, and kind of back into it that way. But that's a lot of work. I would rely more on other deals, how they've operated, and rely on other owners and brokers and agents. And you can probably find out a pretty good estimate for what it is. And then what I would always do is add in, a couple extra points. So if it's 95, go to 93. So that way you just have some cushion baked in. And, if something goes a little bit wrong, you're not stuck.